Hello and welcome to Thematic Intelligence. At GlobalData Thematic Intelligence, we track over 100 tech, industry, ESG and macro themes impacting all major sectors. I'm Kris Cooper, and today I'll be talking to behavioural economist David Lewis, president of the BEworks Research Institute, about what the declining number of ESG-related investment funds means for sustainability concerns. Hi David, how are you doing today?
Good, thanks, Kris. How are you?
I'm great too. We're excited to have you on the podcast today.
I'm glad to be here.
I recently covered the news of a decline in the number of ESG funds being launched in the second half of 2023, as well as several high-profile funds dropping the sustainability label from their names. Why do you think there has been a decline in the number of ESG funds launched?
Part of it, I think, is an emergent concern about greenwashing, that a lot of funds which claim to be ESG were in fact not really ESG, and they were able to fly under the radar for a significant amount of time, but gradually there was more and more scrutiny on what it meant to be an ESG fund. And there were a couple of high-profile cases of funds that, in fact, were accused and it turns out guilty of greenwashing, calling funds an ESG when it wasn't really an ESG.
I see. So to what extent has the SEC ruling from September contributed to existing funds from the likes of Morgan Stanley and UBS being renamed to omit sustainability phrases?
I think that's absolutely been the fact. And I think there's a lot more organizations that are now emerging with sustainability standards. It was a gray area, whether Morgan Stanley, UBS, any of the others were guilty of greenwashing or not. In their defense, you could say there wasn't really a lot of clarity on what ESG was and how to be in compliance with ESG. You could argue that they were offering funds that weren't really, in fact, ESG, but before the ISSB standards and before IOSCO, there's a number of organizations that have been working very hard. The CFA Institute, as an example, has been working on it. Recently, the World Economic Forum partnered with the big four accounting firms, Deloitte, EY, KPMG, PwC, and came out with stakeholder metrics. So I think as there's been more clarity on how to actually measure ESG factors, I think some of the investment managers have responsibly decided to rename their funds because they've realized under the emergent metrics, which provide more objectivity and less subjectivity, that perhaps their funds really shouldn't have been called ESG.
So perhaps this could be perceived as a step in the right direction for greenwashing.
I think it is, and perhaps some of them will now reevaluate, change the investments in the funds, restructure them such that they do comply with the new emergent definitions. And you may see them relaunching of funds that actually are compliant with the new directives.
Alongside this lack of clarity around ESG that you talk of, some banks are citing a lack of profitability in a realignment of their funds. Is there scope for ESG funds to be profitable in the long term?
It's difficult to anticipate that. The profitability of the funds really is something that they can manage. They can manage it based on the way they manage the funds, manage it by looking at the MERs. The funds may be more expensive to manage and run in order to ensure that you are in compliance with the directives with respect to what does comply with ESG. So they may add additional expense, but they can then increase the MERs to cover that expense. The question is then, are consumers willing to buy these funds, which may have higher MERs, reflecting the more complex management environment the funds have to operate in? And then it really comes down to a consumer. Are consumers willing to purchase these funds when they look at expected returns, covariance with other assets in their portfolio, the MER? Not a lot of consumers actually really look at MERs. If you look at the distribution of investors, there's a small number that could actually tell you what the MER in their funds are. People in the financial services industry focus a lot on it. It's an important metric. The irony is that a lot of consumers actually don't know what it is and don't focus on it. So if you have a fund with a 100 basis point MER versus an ETF with a 5 basis point MER, the number of consumers that actually understand the difference, I would argue, is rather slim. To the extent that people believe there's benefits in ESG, whether it's functional benefits in terms of returns in their portfolio and diversification, covariance with their other assets, whether there's emotional benefits, they feel good about owning an ESG fund and doing something, or expressive benefits where they're virtue signaling, wanting to brag to their friends that they're invested ESG. If those benefits are sufficient, they really won't care as much about high MERs on the funds.
I see. 60 of the largest banks in the world have contributed $4.6 trillion to underwrite debt for equity insurance related to the fossil fuel industry since the signing of the Paris Agreement in 2016. Considering this, do you view the decline as more of a sign that funds are abiding more strictly by regulation, or that the world of finance is taking ESG less seriously?
Surprisingly, they are. And if you were to look at it and try and find the economic rationale for that, as an example, if you look at climate change and the effect of climate change on property and casualty insurers, it's substantial. So there's an economic motive for them to consider those factors. And if you think about fossil fuels, there's a direct link between global warming and fossil fuels, and that global warming is causing changes in climate, and that's causing changes in everything from agriculture through to, as I discussed, P&C and casualty insurers, and hurricane or flooding damage as an example, or weather damage. So pardon me for being somewhat cynical, but a lot of these big banks aren't doing it because they're motivated by this charitable desire to save the planet. They're doing it because of economic fundamentals. It just makes sense. Social in particular is an example. If you look at the societal changes that have occurred since COVID, workers who are less productive, who are detached, who lack loyalty to their employer, those social factors are critically important. And there's a lot of good academic research in the area of finance that shows that companies that pay attention to those factors, social particularly, actually have superior performance.
Okay, and for those that aren't as on board with this, what can be done to ensure those with the money and capital behind them begin to act in a way that aligns with environmental aims?
I think if you look at the factors as an example that, as I talked about before, the WEF stakeholder metrics, I think as companies start to actually look at those in detail and realize that there's a link to performance, they'll do it naturally. I think the countervailing force there is the politicization and the polarization in North America. It's less prevalent, much less prevalent in Europe or Asia. But in America, it's somewhat like wearing a mask during COVID. Basically, if you had a mask, you're a Democrat. If you didn't have a mask, you were a Republican. And you're finding that in some of the states as well. Texas in particular has banned companies from operating there. And economic research has shown that the cost of debt for the state of Texas has increased substantially as a result. And so I think solving that political polarization problem, ESG should not be an issue that's on a political spectrum. It affects everyone. Whether you're a Republican or a Democrat, if your house gets destroyed by a hurricane in Florida, that's a result of climate change.
Nicely said. Well, that's all the discussion we have time for today. Thank you, David, for sharing your insights on this important topic. It's been really interesting to hear your perspective on these matters.
Thanks, Kris. It's been fun. Take care.
Thanks, everyone, for listening. And from us in Thematic Intelligence, see you next time.